We're live. We are live. So, okay, everybody is here. Yeah. Let's start. All right.
Next.
We are continuing on H 933 miscellaneous tax. And we have testimony on section 21 through 23. Jason Batchelder, Jason here.
Yes, ma'am.
You're here. Come on up.
Thank you.
Fish and Wildlife section.
Madam Chair, do we have room for general counsel as well? She's got a significant portion.
Okay.
But I
have been on you and.
hang on, I'll make some electricity. So okay for her. So good afternoon, everyone. Thanks so much for having us. My name is Jason Batchelder. I'm Fish and Wildlife Commissioner. For those of you who don't know, I was also DEC Commissioner for 2 years and then was blissfully retired individual for that. And I was the Chief of the Warden Service before that and a game warden, regular old game warden before that. So I've been with the agency a long time. I mentioned that because this is an effort, our area license, which is the sort of the reason that we're here to talk about this effort in 933 has been underway for a long time, at least in its idea form. And I just wanted to ask for maybe a show of hands as to who has heard the area license proposal that we put out, or who is aware of what the ask is as far as our area license goes, because it's important. Thank you, man. If you don't, I'm just going to give you
He knows too.
the quick version.
Lightly upfront.
Okay. So this area license is essentially a license for folks who don't already pay into our ability to have fishing access license, or excuse me, fishing access areas. We have 205 fishing access areas around the state. They require kiosks and mowing and snow plowing and maintenance. It's expensive. Hunters, anglers, trappers, and motorboat users pay into a system. We get return from the federal government in the way of financial aid to keep these areas going. But we also allow these areas to be used by paddlers, stand-up paddleboarders, kayakers, canoers, and we love to have them, obviously. No matter what you do, you go paddle out to an island and have a picnic, 100% fine, right? But these places are built for and built by anglers, hunters, trappers, motorboat, registration holders. So our ask is for paddlers to have a license to use these access areas, and thereby paying into this system that is getting more and more expensive. The Vermonters that we see moving here aren't necessarily moving here to fish and hunt. Some are, but many of them are they're all want to use the land. It's getting more expensive to manage this land. Our budget, as you know, is shoestring, and so looking to add funding to our base budget, which would be used in some way to fund these access areas. It's a fairness piece. I don't see it as a typically onerous ask. We'd be looking at something around less than the cost of a fishing license, which, by the way, would exempt you from this. If you had a fishing license and a hunting license, trapping license, motorboat registration would all exempt you. This would be for folks over 18 to be able to pay into the system. And so, what could go wrong, right? This was our ask, and I thought it was wonderful. We were gracious to have the administration's support to do this year, and we have the authority through 10 BSA 4132 to set these fees on our own life, our licenses on our own life. And so this idea was not as wonderful to everyone as I thought it was, and House Ways and Means, I believe, is who started this bill, inserted language to repeal our ability to do that. And I'm almost ready to turn it over to General Counsel, but we, looking at the language that they've introduced, would suffer a lot of unintended consequences by way of this repeal than just this area license. And I think that's a good place for me to stop and turn it over. Oh, please watch it. Love some.
there's been some tension between the legislature and the administration over fees and who has the authority to set fees. And I thought that the House had made you whole for this year and then said that the creation of a new fee should go through the legislature, since the governor won't let anybody else raise the fees, I think is the tension that's
Sure.
going on. So you were not losing money this year. You are held harmless.
Correct.
Yeah, okay.
Correct. That is correct. And for the full amount to come to fruition, we would need 4 to 5 years, and we are looking at upwards of $250,000 to $290,000. I've said more in testimony, so forgive me if you're listening for the third time. But we're estimating that number at the moment. And for clarification, this law was passed by the General Assembly in 2004 and has been in existence for our ability to do this for 20 years. And it is unfortunate to me that I'm the commissioner of the day that's incurring this. We do not abuse this in any way, and I completely understand that tension, Madam Chair. I completely get it, and I wouldn't want to leave
I think the
ignorance there at all.
intent is to give the fee.
Yeah, and $50,000 the first year is a wonderful gesture, and it would make us whole even sooner than we hoped, right? For 1 year, but we feel that the $250,000 in perpetuity is at risk here by having to come back with this ask year over year, as there are no guarantees, right? And having the administration that we do, we've looked at this ability to the charge a paddler's fee, whether it be a sticker or an annual fee, for a long time, and would worry about future administrations not looking favorably on this ability for us to do this. So that's just me.
Okay.
But I'd love to turn it over to Hannah.
Someone who has put her kayak in, your fee on more than one occasion. I wouldn't have a problem putting this in yours, once it was waterproof and didn't fall. I might try it.
Sure.
For the record, my name is Hannah Smith. I'm general counsel with Fish and Wildlife. And I wanted to just taking a step away from some of the policy discussion around the area license to look at what the bill language does in terms of administration of our current fee authority. Just from a purely administrative standpoint, the department's perspective is this complicates things. If the objective is just to subject the department's ability to adopt an area license fee to legislative review, I think that can be done in a simpler way. What this does is it repeals the rule that we currently have that establishes camp tuition and rental fees for our Buck Lake and Keno facilities, as well as there's a fee range for licenses and special use permits, which we use in a very limited way, which I can go into more detail on that.
That hunting and fishing license, right?
No.
We don't.
Oh, sorry. Yes, the legislature. Yes.
That's what I thought.
This
can
rule
remember
does not. Yeah, the legislature, the fee authority that the department has exercised under 4132 has been very limited. It's really administration of the buildings that we own
Yeah.
for the most part.
And the state campground fees.
We don't do campground fees. That's FPR.
It's just,
It's just Kehoe and Buck Lake are our two educational facilities,
okay,
camp tuition,
yeah,
and then we issue licenses for utilities that put infrastructure on Fish and Wildlife owned lands.
okay.
So it's like a long-term use or construction access across Fish and Wildlife lands. And so the license is not, we don't convey any property rights. It's simply an authorization for some sort of limited articulated activity that's also subject to conditions related to protection of threatened and endangered species, whatever the management objective is on the department land. And then there's a special use permit provision fee in this current rule that also allows us, we issue special use permits for things like breeders at access areas. Again, very limited use of the special use permit. It allows us to authorize certain larger group activities at access areas that are not otherwise authorized under our rules.
Does this get into the fishing derby?
This doesn't relate to the allowance for fishing. It's a totally different permitting authority. Yeah,
That's been an issue locally.
Been there, done
This is
that.
good.
yes. No, these are not related to management of fishing game or hunting and angling. These are licenses purely, these are fees just for use of a very limited subset of department facilities. So that's the way that we have exercised our current authority. And that is what the rule does. And this bill language would repeal that rule and require us to adopt a new rule with the camp fees and different license fees for a limited subset of what we currently license. And then it would also require us to come back to the committees of jurisdiction next year with a report for any new fees related to the use of fish and wildlife lands. And I think, setting aside the area license, we would essentially be coming back to the legislature with the same rental fees that we currently have in rule for our educational facilities. Like that's what we use this rule for. And so I think that we understand the objective of having a full policy discussion around the adoption of an area license. But as the person who does the rulemaking for the department, I just see this as being an administratively burdensome way of achieving that when we have not used the existing rule to do anything other than set limited fees for our facilities.
Okay, so if this committee decided to keep the existing rule and then just say, you want to do a new fee, come back to us next year, that would work better for you.
That would certainly be from an administrative standpoint.
Much easier.
And it would create far less, I think, our business office and our education programs that administer the camp, the summer camps have had, they're very concerned.
People do reserve in advance.
Mhm.
And so this would make it difficult for you to tell them
What the fee
what
would
the
be.
fee would be.
Mhm.
Okay.
Thank you. But I'm looking on page 17 of the bill. Do you have it with you? Hannah? I think that the language in A, B, and B2, the language on page 17 does exactly what you just suggested. It says that the commissioners can issue license, set the tuition for the Green Mountain Conservation Camps, and adopt by rule fees charged for license and tuition.
Mhm.
So
Yes.
what is it specifically that you don't think this does?
Well, specifically to that language, we currently also have the ability in the rule to issue special use permits, which are slightly different from licenses. But to your point, this does preserve the important authority that we appreciate in order to be able to set camp tuition essentially based on the costs that we're incurring for managing the camps.
Yep.
What section 22 of the bill does though is it repeals that current rule. So then, yes, the bill maintains most of our authority, but then it repeals our rule and requires to come back with a new rule that essentially establishes the same fees.
Okay, so it's specifically section 22 that you're concerned with. Section 21 retains the part of your.
For the most part, yes. I mean, I think again, that special use provision has been really helpful in allowing us to authorize activities like bird watching at access areas where somebody doesn't need a license, they're doing the activity for a couple
That's what
hours.
the public has been sending me emails about hiking, bird watching. And I wasn't clear as to where the entrance point was that you charge.
Yeah, I mean, I think the term special use is really broad, and that's the concern that people have about having commissioner retain special use. You used it to create a new fee that hadn't been contemplated before. And so what I heard you say and what I've heard you testify in the morning about is you need the authority to set these the camp fees for the Green Mountain Conservation Camp, and these are not campsite fees, these are for this Green Mountain Cancer Conservation Camp. And the license and tuition. But. So this retains that. I understand if deleting the rule means you would have to publish a new rule, so that might be problematic, but I don't understand what you're missing here.
Really just the special use permit authorization.
But that's the thing that is causing the concern, because the commissioners use that authority to create a special use fee that the legislature isn't
Well, we haven't actually,
concerned about.
we have not created any new fees.
Well, you proposed one.
Yeah.
Yeah.
And I think that actually it was proposed to be a license fee. Currently in the rule, there's a fee range of $50 to $10,000 for licenses and special use permits. That's all the language that's in there. And the special use permits, we really have to use in a very limited capacity. They're primarily group activities that somebody is, like pond hockey tournaments. And the licenses are authorization to access Department of Lands.
Yeah, I think that's the difference, especially using you probably use the $10,000 if they want to have a fish concert out on Lake Groton. Something.
That might be a good idea.
Yeah. I don't know, given the last, but the fee to access an access area isn't a special use. It's a new license. It's a new creature. And I think what the legislature is saying is, we know every time you get a request to use something for a wedding reception, we can't be setting the rental fee, or the damages fee or whatever. That you can do. You can manage your properties. But this is setting up a new license, like a fishing license, a hunting license. And I think that's where at least the Committee on Ways and Means seems to feel, because the governor also established a flood license plate, established a fee for said license plates, and appropriated the fees for such license plates, none of which are technically under his authority. That, but it's very hard for the legislature to push back. And I think that's made this kind of tense. And you unfortunately was the person in fee to come. But so we will work with council and see if we can make it clear that it is when you are setting up a new fee for a new activity, that's when you need to come to us. If that,
Yeah, I think that would really, like, we're not advocating for some loophole for the legislature's review of the. And I think that, I put together some potential language that could be added to the current 4132 that would essentially prohibit the establishment of new recreational access fees. Just, because I recognize that the way that the statute is currently written, yes, a license fee is open-ended. And it's not our intention to, abuse that authority. It's really our intention to be able to, at this point, manage our facilities in a way that accounts for the maintenance and stewardship costs that we incur.
okay, if you can just email that to Charlotte, we'll get it, see it in our council.
I would like
We go forward.
Michael Grady to weigh in on this.
Okay.
He's the drafting, no offense.
Michael is the director.
It's his
Okay.
area that.
And we will forward it to Michael. Okay?
I think that I hear you that you're not trying to find a loophole, but you did find a loophole and tried to exercise it with this new license fee. And that's what we're trying to prevent. And I just want to make sure that we're doing that.
Let's hope we can get Michael before June. This tends to be very busy, but we will, if you send that in, we'll get it down to Ledge Council and let him come in and help us, okay?
Thank you.
All right. Anything else?
I think that covers it. Thank you.
Thank you.
Thank you all so much.
All right, same subject. We got Percy, Chris, Patrick. You all have a script to.
What I would have would be, a draft committee amendment with the items that I've collected so far.
Okay. Have with us. And not on the agenda, representatives from the city of Burlington. And I know we had testimony yesterday.
We're trying to,
Really? I like talking to
trying to fix it.
I like to.
We're fixing it.
Share the language.
No,
We've had two or nothing. There's no fifth.
I just don't want to close out until Lou.
what is going on?
Oh, I said.
What? Oh, you have language.
Well, the city has
The
language.
city has
Yeah.
language. It hasn't. Okay, no, that is Godfrey. Okay, Kara, it's under Kara,
Mhm.
and we have the Burlington base value. Okay, so we heard from Tanya Morehouse yesterday. There seems to be a concern. The auditor's office feels that they need to make sure that the ed fund is being reimbursed as much as they should be. The concern I heard was that the towns, we changed it, I think 2 or 3 years ago, so the towns only get to have to send 35% into 30% into, they retain 30%. The old rules were 25. But in the Burlington language, if I'm getting this correct, and David, I don't know if you want to come up, or you feel free
I'm
to
happy.
talk over there, or Kara.
This is Ashley. Yeah, Kara's.
There's
Ashley.
not here. I didn't think that's who this was. Yeah,
I'm happy to.
whatever works. The way I heard it is one of the concerns is that when we did the TIF extension in 16, we did not change the underlying TIF agreement, which says that that split 25-75. Right now, it goes through 2025. When we did the extension, we didn't change that date, which means that, I guess, if someone wants to hire a lot of attorneys, what that split is not clear in the law. And so, if nothing else, it sounds like we should make legislative intent better. We upped it 2 years ago, a couple of years ago, where 30%, 35, that's pays into the ed fund, I think we're to 35. But the floor is yours.
Thank
Tell
you.
me if I've gotten all of that from yesterday correctly.
Very close.
Okay,
Very-
close is good.
For the record, I'm David White. I'm president of White Brook Real Estate Advisors, consultants in the city of Burlington on both of its TIF districts, and actually work with many other communities in the state on TIF as well. And with me is Ashley Parker, who is the director of capital programs for the city of Burlington. I think is the title, something like that. From the city's perspective, we believe that the current situation is crystal clear.
as I described a couple of days ago in my, Zoom testimony, that, all that 2016 did was to say you could extend for the 3 properties only that encompass City Place, the existing circumstances forward until 2035. We think that's clear. The auditor's office thinks it's unclear, and we're not in the mood of wanting to fight with anybody about this, to be perfectly clear about that. And so,
Started out in 16 when we did this.
yes, that's right. The simplest thing you can do, frankly, it would be I heard Tanya Morehouse yesterday in her testimony, which I did listen to last night, and way too late after dinner. I was tired, but anyway, I heard her say, "Look, the underlying thing here is that the legislation failed to be explicit that the 25% payment would also extend from 2025 to 2035." I think the legislation as written in 2016 that says you're simply extending implies that the city's been acting that way and actually paying those payments subsequently. The simplest thing for you to do if you wanted to accommodate that would be to simply say, fine, we will explicitly say that 25% payment for those funds from 2010 forward would get extended to 2035. That's really simple. That said, let me say a couple of things. First is that we agree with her. She made also the statement that the garage that was, she talked about the $847,602 value. There was this garage that was actually owned by the city because it owned it, treated as non-taxable, but that they claimed should have been taxable right from the get-go in 1996. The city agreed in 2023 that it wouldn't fight that. Originally, it opposed it, and I'm not here to argue one way or another, but the city did agree in 2023 to make that adjustment. She said that as of 2025, it hadn't been done. In fact, it has been done. We have a copy here of the updated certification that's signed by Jessica Hartleben from VEPSI and by PVR and the city that includes that update. So it has been done. We agree with her. And the email that Cara Almswari, the CEDO director, sent earlier today shows the impact of that, which is to add that 847. But that's already been done. It doesn't have to be done. It's been done. We agree with her. The second thing is that she said that it would be simpler to administer if we only had one original taxable value, whereas right now we have two. We've got a 1996 original taxable value and a 2010. And she's right, it would be simpler to administer. Now, the problems we had, and the city did have problems with this earlier on, but we have new staff and they're doing a much better job. I think those problems are gone. I think PVR has figured it out, and I think it's all working smoothly today. I don't think it needs to be changed. But we agree it's easier. And so if you wanted to, the city would not oppose saying, fine, we're going to, instead of having a split, because again, to reiterate what I said a couple of days ago, right now, any increment, and it's only a couple $1 million. It's not a huge amount of increment. I know that for some communities that's huge. For Burlington, it's not. The incremental increase in value from 1996 to 2010 was only a couple of $1 million. And that one under
wasn't a really prosperous time.
Yeah, under that period of time, according to current statute, as we understand it, the city is able to retain 100% of the education increment created during that period. Thereafter, 75%. If you wanted to, I believe I said this a couple of days ago, we're still there to say, let's get rid of this split. Instead of 100% for that movie and 75% for later, let's just go 75% the whole way. We're fine with that. It's only, as I think I said the other day, roughly an average of $17,000 per year over the next, between now and 2035. It's just immaterial either way. Moderately easier, a little bit more complicated in the legislation to have that, but sure, we can do that. It's not going to have material impact for the education. It's slightly better for the education fund, but not a material impact on the TIF fund. So we're fine with that. As for the percentage, under, just to correct one thing, under current statute, if you set up a new TIF district, municipality has to send 30% of the
Okay.
education tax to the education fund. But at the time that the Burlington TIF district was extended, it was only 25%. And it would be a material change to reduce that, to increase that from 25 to 30. So we would request that if you're going to make changes, that you leave it at where it is today under current statute, which is the city only sends 25%, not 30%.
Did we change it for everyone else?
It was only changed for any new going
That's
forward.
what I
Everybody
thought
else was
going forward.
grandfathered.
Don't renegotiate.
No.
Yeah.
And that's where we are. That's
Yeah.
why, that's why the 100% existed. It was
Right.
grandfathered because
Yeah.
that happened prior to statewide education tax. But at the time the city extended it, it was new circumstance. And so that's when the new rule applied and the 25%. And we think the same thing tax today to require the city to increase its payment from 25 to 30%. That would be a material impact. That would be very hard on the TIF fund and
Okay.
would, I think, put it in jeopardy.
Okay. Committee. Question
For Ted,
for Ted. Okay. Can we release David? You can find this for a comfortable spot.
I'm comfortable right here, but Ed, if you'd like to trade places.
Yes, we're trying to knee replacement.
That's fair. I'm happy to be in the sidelines, Tevin at Joint Fiscal Office. Happy if there's a specific question or just to talk more generally about the situation here, what would be most helpful for the committee?
I think we've got two suggestions. One is we can take they've got two base amounts now. We could combine them, which would make about $17,000 a year, might cost them that much to do the paperwork. And we could make it clear that extending that 25% payment into the ed fund goes. Right now it ends at 25 because no one thought to extend it. Was missed when we did the extension of the tip. So if we extended just that date, it would take the ambiguity out as to what the payment is. That I may have made mistakes, but I think that's what's happening.
So all this to say, and I am going to channel John Gray to a small extent, but I'm not a lawyer. I don't want to divine anything.
Neither are we, so.
Exactly. So generally speaking, I agree with David White that there is clarity amongst folks who are administering this, that even though it isn't the most straightforward, right? The 100% of increment from 1996 to 2010, and then the 75% from 2010 into the future, and the use of OTB in 1996 and 2010. It's not the most elegant solution, but it is certainly working. It is certainly being administered in that way. I think if the committee wanted to enshrine current practice going forward, I think some intent language to specify those retention percentages. I think any change to either be, making it consistent to use one OTB and one retention percentages would be, although small, change again. You're changing the administration again. So you may be trying to simplify it one way, but then adding even another change to something that's been changed a whole heap of times. So I think that's a consideration for y'all. But if you wanted to.
Okay, I got the two people from, I've got the rest of the committee. So I'm going to start doing straw polls and then Kirby, are you the one or John? Who would draft this one? John, okay. And John is tied to a chair on the floor is,
John has already drafted some things for us, I think, yeah.
okay.
I haven't received anything from John. No.
There is, John did put together a whole series of findings and intent language around the municipal increment retention piece. It would be I don't want to speak to the drafting lift, but I imagine you could start there and add a piece about.
Ah,
Yeah, it was
Yeah.
always for municipal, it was,
Okay.
Yep.
I'm working on that.
Let's see if he sent it over yesterday.
Between Ted and I, we can connect with John to get that language. I'm just saying I don't have that. at the moment.
I don't have something from John on.
Maybe I dreamt it.
If I may, I've seen a draft, that I believe, I agree, simply addresses confirming the right, the city to retain 100% of the municipal increment. It does not address the issue of extent of the education tax. In fact, his cover note explicitly says that he did not understand that was in question, but it is in question. And so I do think that draft would need to be, if you choose to do anything more than simply say, look, let's explicitly say this, all the existing extends to 2035, then I think that draft would need to have language expanded.
That's probably the most important issue.
Yeah.
May I add one other thing, which is not critical, but for every other TIF district in the state that I can think of, there may be an exception. VEPSI has the authority under existing statute and rule to adjust the percentages that are retained downward if there's additional, if there's excess increment. And because for the waterfront TIF district, it's explicitly stated in statute, VEPSI doesn't give percentages. VEPSI doesn't have that authority. And
See, you were before Pepsi, you were before the statewide tip.
exactly. And so one thing you could choose to do, this is optional, it's not critical, but you could choose to explicitly, if you're going to do something more than just extend it 2035, you're going to do this other stuff, just add a phrase that says, going forward, excuse me, VEPSI has the authority to make a decision to lower those percentages of education and municipal tax retention if it's found that there is sufficient excess revenue. Because it does nobody any good, the education fund or the municipality, to simply retain more revenue than is needed in the TIF fund until 2035 when it would get dispersed. And so I expect all the projections I've done, including what I testified on a couple of days ago, where I said current projections say that I anticipate about a $4 million surplus at the end. That assumes phase 2 doesn't happen at all. That's the piece that still fronts on Church Street. And I've done that because I'm a conservative analyst. And I don't want to make assumptions about something I really know the details about at this point. But the reality is I expect it will be built sometime in the next few years. And that's going to generate revenue we don't need. It's not needed for the TIF district. And so I think it would be less cumbersome to allow the city to go back to VEPSI to ask, look, here are projections. We have this excess revenue in the benefits both the city and the ed fund. We request that you reduce these percentages. And right now, they don't have that authority for this district. They do for every other.
So committee, would we agree to that?
Sounds good. I think that's great.
All right, I'm looking, I need some nods in the far end. Okay, all right.
It's something we can do.
Now we need to get it drafted, so we will make it clear that the payment stays at 25 through 2035, and then that if you are retaining excess amounts, you're sitting on money, that you will pay it in. I assume in a lump. All right, we
It
need,
may not be, excuse me if I may, it may not be a lump. It may be just simply going back and saying, from this year forward,
Okay.
we will reduce the percentages
okay,
retained or
that they can
something.
adjust.
But we can go back to
You're
VEPSI
generating more.
and work that out.
All right, so if we can agree to that, we will. Fine, Kirby, do you have enough information to send request to John?
I think Ted has something else.
Ted?
One question I would have for the committee is at which point you would want that check-in on the education increment retention percentage to happen. In current statute, it's after 10 years, I think, where they're supposed to adjust that percentage. So from 2025 to 2035, if you kind of hit the midpoint, could be a place to check in. I just as a explicit place to do that check-in as opposed to letting it,
Sit till the end.
yeah, leaving it till the end. And that would be one piece.
Can I chime in? So Kirby Keeler, City Council. As far as I know, I've not received from John Gray
Yeah,
any official version. He will have to review this further information and consult with Ted to make any change.
Okay,
John
yeah.
is also on the House floor
yes, we know that.
for the education bill. I'm missing that right now and just hoping they don't have questions about my parts.
Thank you.
So this is all to say, like, I wouldn't be comfortable adding anything without John.
No, I
expressly telling me
don't
to.
want you. I just want to, someone can send John an email.
But I'm not sure the time at which that will be done.
Okay. Oh, no, I don't think we're gonna get it this afternoon. I would like it by tomorrow afternoon, so we can, between the two of you, can you just
Okay.
let John know what we need? And if that's agreeable.
There is, just so you know, draft language from John posted on our website on Tuesday afternoon.
On Tuesday.
And I think it's a bunch of findings.
Yeah.
And I think it's probably just for the municipal.
So my understanding is that there's been a further request right now to adjust that language.
Yeah, but just so you know
Yeah.
that language is there.
Yeah, I'm aware of it. I'm just saying that John has not told me this is good to go, so that's why I wouldn't.
Yeah, well, it sounds like we have more changes to it. anyway.
Yeah,
Okay,
thank you for the time.
no problem. Okay, I think we've got a resolution that might not make the auditor completely happy, but if that's possible, then this will make him a little more comfortable, I think, and at least has a clear path forward. Good luck with phase 3.
Thank you so much. Really appreciate your time.
Okay, committees. Kirby's, you have the draft language from yesterday.
I have technical changes, mostly from the tax department, but also some less council things to point out. I call them technical because it's very much drafting related, but there's policy implications of portion things, so it's just something that we need to go through at some point. And also it might give you an idea of where this committee's amendment stands now, so you know what's in there and what's not
Okay.
at the moment.
Okay, that would be
Okay.
a big helpful. And committee, I did, at your request, meet with Jill from the tax department property valuation yesterday and convey our request that they send a clarifying letter that at least to broadcasters, they don't have anything that's in the law, and it's towers seems to be what's attached to the towers maybe, but towers, it's real property. It's not typewriters. That they would make that clear and that they would make it clear to everyone what they were obliged to report. Apparently, this is being done by a contractor who can be a little rough, but who has been upheld, I believe, in both New Hampshire and Massachusetts. So we are, but
What?
there's a contractor, I guess, doing this inventory and stuff for the tax.
What do you mean can be a little rough? and
Well,
upheld?
apparently Massachusetts and other states are doing similar things. And there's been appeals by the industry,
But is the contractor doing something wrong?
no.
Like, okay,
no,
that's
we
what it
know.
sounded
I
like. I
think
was
it's
like,
just
what did
the
you-
tone of the letters that, so
Oh.
we're going to watch it. I don't want to put anything in law at this point because it's in law of what is taxable. And we will have to watch it, and I think the industry will let us know if there's a continued problem. But it is clear that the broadcast industry was not ever. It has been telecom, and that is clear in the law.
So we're not gonna do anything to the bill?
Not at this point
It's kind of late in the game.
that I know of. Somebody has some suggestions. We can look at them. Okay. All right, so Kirby, you're next. Don't go to Patrick. Oh, yeah, and the yield bill.
Good afternoon, everyone. Kirby Key, Legislative Council. I'm just from the Zoom. Apologize for not being more prepared. I think I'll give you a summary of what I have so far and plan to show you language for. There's the items that the department covered yesterday, that the committee asked to be included. That's three parts. There are 4 or 5 changes within the federal decoupling language that are technical in nature, but I want to make sure you understand everything that's going on there. One of them, as I mentioned, that the language we had did not quite match the intention from a floor amendment in the House, so I want to clean that up. And then there's one grand list, or one effective date change relating to the communication property issue. That's the only thing I have on that so far that this, I've received requests to be included. So the definitional changes for the statute on communications property valuation, I do not have language for at the moment. There's been language bouncing around to give you an update on that. I think the chair may have just mentioned this, but just want to reiterate that I was able to connect with Maria Royal, who is the original drafter and worked on that bill.
She did send us the original language.
She provided some clarifying language that basically just restates the plain language that, yes, two-way communication is different than one-to-many communication. And that's pretty much what her language says. All the other proposals or language that were thrown around, she has said that there's problems with those things that could create further problems, and had advised not to do anything like that at this point. So that's the update I have on that.
Could we reference in here? It says on or before March 31st, each communication service provider shall submit to the division a sworn inventory of all taxable communication property and reference the statute where it lists or list, because it's not a long list of what they need.
As it's written, that statute, from my understanding, was open-ended on purpose. That there could be,
So,
it's not meant to be an exhaustive list, and it wasn't meant to be an exhaustive
Right.
list. My understanding of the issue is confusion between the Department of Taxes sending out letters that asked for an inventory if that entity has any of the statutory property to report it, and a difference of interpretation between, does this letter mean we must do an exhaustive inventory and provide that for a bunch of property that's not meant to be valued under the
Yeah.
statute? Or is it okay to just reply that we don't have this property? And I heard tax testify that they would accept
No.
a returned inventory that states simply, we don't have any. And that's what I heard, and what I
Yeah,
how I thought
I
that
think the
was resolved.
confusion is that when you see telecommunications property, the tax department needs to send them what that is, because they have been doing an inventory of all their equipment. And we may need, at least initially, to tighten up that open-endedness so that we can start out by finding out what we have that we know we want to know about. And then if it looks like there might be something else out there, we can send it in.
Well, there's two things going on here, and I just want to just draw a box around them. So there's one which you're just speaking to, which is I received the same documentation from Maria Royale about how the period was added and how that's not an exclusive or an exhaustive list. That Maria Royale provided a side by side that really intentionally articulated that was the intent of the legislature. So the Scott Mackey thing, I don't support making any changes right now. I think they're working through that. That's part of the intent. The other piece is the broadcasters, and that's where we did receive this language from Maria Royale that it's not what the broadcasters asked for, but she thinks that it threads a better needle. That I don't know if Joe Remick saw this, but if we would be willing to look at it, I do like it. It's just adding one sentence to that law, which says the term does not include property constructed or installed as part of a radio or television one-to-many broadcast system serving the general public and owned by, operated by a licensed broadcaster. I sensed from Maria Royale's that would be less problematic for what the tax department is doing. I didn't speak to Joe Remick, so I don't know. I just don't want to get the two issues conflated. I agree with Joe Remick on the exhaustiveness and how that list was not exhaustive, but the other piece, which is not on the screen, about the broadcasters, it seems like there might be something worth considering. Madam Chair.
That's what I was referencing earlier, but we do have some language from Maria that she thought is workable for the issue that Senator Chittenden just mentioned. It's not included in your draft, but that's, as far as I know, the language out there that Maria was comfortable with is that. I can share that. We can switch documents. First, I wanted to show you real quick.
Okay.
What we do have in the Senate Finance Amendment right now is an extension of the effective date for the penalty provisions, that's why we're talking about this in the first place, because miscellaneous tax
Everybody went into
what was thought of as a housekeeping change to include some penalty provisions that were left out in the first place. So that's what I do have now, is that at least the penalties are kicked out a year from what they would have been. And then we put them.
Is this your amendment on our website? Did you send it? I get it.
It's not, because
It's not ready.
it was being worked on as I was walking up here, basically.
Okay.
I mean,
okay.
so this is a check-in that's in a space. I mean, of course, I will share it. And I will share it after we go over it.
Does anyone object to kicking this penalty out a year since? I don't. So that one's okay.
And
I
Pat
think
testified yesterday that was acceptable.
we've got, I think, yes. We were making major changes when we did this bill. We were going from personal or business property to real property. And I can understand why we left it open. But it also seems to be causing some confusion, because we say, it's poles, wires, towers, etc., or anything else. And that, I think, is what's making people, it's just compounding the problem. And it's probably costing more in angst than we'd actually make in money if we pick stuff up. I could be wrong.
Would you like me to share Maria's language right now? And since we're talking about it,
Let's see
go
what
ahead
we
and tackle
can
that.
do with that.
Okay.
biggest miscellaneous tax bill I think I've ever worked on. The other ones are smaller.
Oh, you ain't seen that.
We got 3 more weeks. Okay.
I think we have to pass it
If
out.
we have 3 more
Wow,
weeks,
this is good. It's well done, you know.
When Vince and I were here, this could be the most well-decorated bill. And we are going to lose it because we're not gonna have a vehicle unless the House sent, they're working on a wealth tax. I don't know what well, we probably sent them a couple bills that say tax.
This is the language.
Okay.
question.
So this is a provision in Maria that says if this could be included, if it's helpful to clarify things, it will not substantially affect the rest of the statute or the implementation of this.
May I ask Cody a question?
Okay,
Have you heard from Joe Remick on this?
On Maria's language, I don't think so.
okay, we should send this over. This is legalese, I guess, but should make the broadcasters feel better.
So my reading of this is it's a clarifying statement that is stating what's already there.
The other one is, though, how much inventory are we expecting the telecom? I mean, how far down the list? Are we asking for how many typewriters and?
No, it's listed in statute.
It's listed, but I think Maria said it was left open
It's
and
not
it says
exhaustive.
or anything else.
The reason it's not exhaustive is that new technologies emerge, and so having the ability to.
And typewriter's not new technology, Madam Chair.
True, but it doesn't say new technology, and that seems to be,
I think when she said typewriter,
What's causing
it's a
the
real
problem,
object. As in, but when we talk about real property, that's typewriters aren't that either.
So generous, Kirby.
well, see, we were changing though, we're defining these things as real property. That was the big change in this bill. They're going to be done under the property tax, and the real goal was it put money into the ed fund. The money didn't go to the general fund, which the personal and business property tax did. This made it real property, and I think it was $14 million. I don't know. We raised money. This was an ed fund, a way to get money into the ed fund. And yes, there may be things out there. But
So
this initial go round, if it's causing so much angst, maybe we could close it for this year. And then say in future years, any additional, however you define it, telecommunications, real equipment will be, because Jill said it's getting very complicated at the local level. You got a tower, what do you do with the land under the tower? Is that different than the land abutting the? And so,
I support that language
Yeah.
on the broadcasting thing, because I think that matches
Yes.
what I heard the tax department say. Their understanding of the intent is and how we've always treated these things separately. And that's how section 248 treats broadcasting different than telecom. The other piece that you're raising, I'm not opposed. It just seems like it could be a can of worms that the tax department was less supportive of, because they want it to be not exhaustive of a list because they don't know what's out there. So they're using this process to work through and identify what they think is. Happy to go down that path. I just worry about the deadline for tomorrow to button that off, because it seemed like there was the most opposition. from
we
Jill
can't
on
get
that.
Jill
That's right. I support the broadcasting
this afternoon.
clarity,
She's Zoom.
but the other one, you got.
So am I hearing that I should add
I-
the provision?
Committee, does anyone object?
The broadcasters.
Broadcasters.
Okay,
Okay,
okay, so that,
that's
okay,
easy.
I do have some long-winded explanations of some complicated federal income tax stuff. So just so you know,
Awesome.
All right.
Yeah,
There we go.
so like there is some time
This
to.
is the coupling, decoupling sections, okay, they're all long.
I want to make sure you're aware of, like, it's like maybe I'm the only one aware that we're in for a treat right now. But this,
Okay.
the communication stuff is simple.
Remind everyone, you're not supposed to be on your cell phones reading your emails during the exciting.
So with that, I'm gonna
Come on,
proceed with the
Scott,
other
come on.
things that we have. So, okay, so there's a new section 4A here that goes towards the forest management reports issue that Tax brought up yesterday. Currently, it's still just statutes interpreted by them to require all owners to sign. We have language here that would require only one owner or a forester working on behalf of one of the owners to sign those. So that's what this is.
Resulting in a.
That would be effective immediately.
Then had that multiple property owners sign off on a sale.
So moving on, 4B is added. This is also responsive to Tax's testimony yesterday. This relates specifically to those objections to appeal that third parties can make sometimes. To extend the time frame for that to 30 days. And to base it off of receipt of the appeal by the director, as opposed to the more formal court rules that are currently on.
Okay. And we did get a long list email. I'm trying to find it from the tax department. Somebody asked, what happens? How many days? And we got a long answer on. No, it wasn't this week, it was Wednesday. Thursday.
Was that today from Abby Shepherd, the objection?
It may, yeah, it popped up on mine as somebody other than Abby, but then I think it came from Abby.
But they object
About, no, this was, remember, we were asked about what happens if, when do you mail it? Do you take 20 days to mail it? And it gets there, and so there is a long email. I'm still not finding it.
I think
I've got it, 933 objection to appeal. And this came to all of us. So, you do have that answer. I came in, mine says,
9:30. This was gotcha.
at 9:30, and Charlie, you just sent it out to us, right?
I sent it to you.
Oh, you sent it to me, okay. It is in your legislative email this morning. It's also a message.
Charlotte is on you.
Yeah, this was payment.
Yeah, I'm gonna have to.
Pushed you
I
for it.
can give you more space.
So you
I'm gonna
can,
be using
Yeah.
that.
and this basically
I'll
extends
be
the
hopping around.
time
We'll lose
and
her.
gives more of a date certain. So that people know. It gives a date certain and notification. So that people know how long they have to appeal. Right? The other all still pretty much housekeeping.
Yep. Section 4C is related to one of the things from yesterday also. What this does by itself is it repeals the change in Act 73 relating to the grand list contents when it comes to the contiguous parcels mapping part.
Yes,
This repeal is also in the ed reform bill that's part of the changes, I think, relating to RAD classifications.
there
So
was
we're gonna have
something-
two repeals at both of
It
these
might not be in
things.
there anymore.
I know,
Yeah.
and that's part of why,
It's,
so we'll put it here. We'll put it here too, because the point is, it was never a central part of Act 73. There, it was a kind of thrown in adjustment. So we're repealing it here, and that's part of the tax that asked, just like there's another part of this bill section 20, I think it is.
Yes,
That makes that contiguous parcel change.
it makes it clear that they're treated one way for taxing,
Mhm.
but they are treated as separate parcels when it comes to mapping. And this extends it beyond two, right? I think what's in here is,
The change that the amendment's making effectively is to kick that out a year to, I believe, 2028.
okay,
And so originally it was going to start next year, and I said they're not ready to start next year yesterday. So the substantive change here is to move that to 2028 for that age.
okay. More housekeeping. That's-
Mhm. Okay, and now the fun begins. There's number of changes here, that relate to the change for domestic research and experimental procedures. If you remember, we've already walked through what the House did with that.
Okay,
There was a scenario the department pointed out that's very technical that we're trying to address here. So that you have any chance of understanding, I'm gonna have to walk through the
Okay.
process here. First, we're gonna start with the federal law change. The change was that, under Tax Cuts and Jobs Act,
2017.
when it comes to this one deduction for domestic research and experimental procedures, it was changed from allowing businesses to taxpayers to expense those expenses in 1 year was the treatment before Tax Cuts and Jobs.
Okay,
Tax Cuts and Jobs changed it so that actually you needed to amortize that over 5 years. You can't get the full benefit of the deduction in the first year. Got to be spread over 5. Then HR1 came along and said, actually, we're going to go back and we're going to say you can fully expense those. And if you're a small business that is with gross receipts under 31 million, we'll let you catch up. You won't have to amortize like you've had since 2022. We're going to let you catch up and expense all of those. The ones that you have been amortizing, we're going to let you expense all that in the next tax year. So for the Vermont change, when Vermont went to decouple under that House version of things, a lot of work was done on this, and where they landed was, for the small businesses, 31 million of gross receipts, we'll allow you to do the federal treatment. You can fully expense in the first year if you're those types of businesses. But if you're larger than that, we're going to say, we're going to use the pre-HR1 treatment. You've got to amortize those over 5 years. What we did not address, we addressed a lot of things because there's a lot of scenarios that can happen, but what we did not expressly address, and the tax was worried about if they had the language there to handle it themselves, was if you're a business that, what we did address was if you were a business that could catch up, if you're one of those small businesses that allowed you to fully expense, we addressed that scenario, but we didn't address what about the ones who chose not to? What about the small businesses that wanted to amortize over 5 years and just keep doing it, not take the catch-up option under HR1? So when we wrote our solution and the decoupling, we didn't take that scenario into account. So there's a reading of things if we don't change the language, where a small business chose not to catch up on the federal level, so they're still amortizing over 5 years, but we allow them to catch up in Vermont. And there's a scenario, an argument that they could double dip, that they could, in the next tax year, they would expense all of the last 5 years worth, and they keep on doing it at the federal level amortized, which would flow through to Vermont. And they'd end up getting kind of double. So that was the scenario where tax said, well, the more we looked at this, the more we realized that's a possibility. So let's fix it. And so that is basically what a lot of what we're going to be looking at is doing, is just preventing the double dipping. So there's a reference, for instance, here to this reference is to HR1. It's the public law citation for HR1, referencing a subdivision within that F2, which is the option to catch up for small businesses for what they're currently advertising. That's where the option lives. That's why there's that, why we had to include that citation. This is like the federal version of session law. So we're having to reference that to account for it. We do that in both of those places. This is where we're saying you have to add it back in. But then below where we're saying what you can take back out, where we're allowing Vermont deduction, language is being added to account for what the Vermont deduction allows. And so I think that this might be the most legally subdivision, all of Vermont law. But it accounts for all the scenarios that I was just talking about. So in total, I don't know if you want me to read it, but for a taxpayer that qualifies as an eligible taxpayer, you want me to? As defined under subdivision I-5 of the subdivision 18A, and it has domestic research and experimental procedures as defined under 26 USC. No, yeah, I don't think you want to pass out. I tried reading this to Rick yesterday.
If anyone wants to look out, we want to standard annotated right here. Okay, Kirby,
Mhm.
prior to 2016-17 Tax Cut and Jobs Act, small businesses based on $31 million in proceeds could deduct. This is the domestic research and development.
Experimental, is the word,
Experimental,
but it's,
yeah,
but you can
R&D.
it's a deduction for R&D,
Yeah,
and then there's a tax credit for R&D.
okay, they could amortize that expense all at once.
Back, yes.
Okay. Tax Cut and Job Act said
Mhm.
that you could amortize it over
You
5.
had to.
You had to
Mhm.
amortize. So any R&D expense was being amortized over 5
5 years. So basically it comes down to between 2022 and 2024 is a period where where all these businesses were amortizing.
Right,
And HR1 lets them fully expense for those, the
Right.
small ones only.
so the question is, if I incur my expense in 2023 or 4.
Mhm.
Because if I did it in 20, I advertised it by 25. But expenses that happened after that, I still have something to amortize.
Mhm.
Then said, from now on, you can do it all at once, but you've got this group of a couple years that are in different stages of amortizing that expense.
Mhm.
And the catch-up allowed them to amortize it.
To go ahead, whatever's left that they haven't gotten the deduction for, to
Right.
go ahead and take it all at once. They
All
could,
at once.
it was optional.
Or they could continue to, oh, this is making it even more,
And,
okay,
and what the department learned when, as we were working on this was all of us had assumed that if you could catch up and get that deduction now, you would. But for some, it wasn't worth going back and amending the return, hiring an accountant. It just wasn't enough money to be worth
it's
it.
our small business.
So what I was told from tax is that they think about half of businesses will not do the catch up. And so it's a pretty large
So at
group.
least for 5 years, there's going to be some businesses at the federal level doing the
And
amortization
they're gonna be taking that option in Vermont.
in Vermont too. Now, this bill says, okay. And this stops double dipping.
This stops the double dipping, and it also partially clarifies exactly how it would work like I described it, because without addressing it, there could have been some confusion about, you know, what do you want us to do, Vermont? Like, for my particular business, what bucket do I fall into? Am I advertising here? What am I doing? And so we've now laid out all the scenarios for the catch up and going forward, and for businesses that are small one year and big the next. We think we've got all this legalese to cover the scenarios.
Okay. And I think on this one, we're gonna have to take your word for it.
Me too. We'll find out.
Leaving Abby Shepherd, right? Okay.
Abby and you know, all the folks at
those
tax that
folks
we're
over there.
working
All
on.
right, they haven't steered us wrong yet. Okay. So then we have another section in which, because this is all R&D at the federal level. We then have a section. This is in the section on how we're going to treat R&D expenses in Vermont to
Mhm.
Vermont-based businesses. Or no.
Corporate income taxpayers in Vermont, and remember, that actually has nothing to do with being Vermont based.
No, it does not. Okay, so we dealt with them. Now we go back and we change percentages of what you can deduct.
At the end of the day, the policy change around this is we've coupled for the small businesses, the 31 million or less in gross receipts, we've coupled with the feds.
Okay,
For larger ones, the House made the call to not eat that as far as revenue goes in the short term, and to require the pre-HR one treatment that you have to amortize it over 5 years.
okay.
Um,
Yes, if they did it all in 1 year, it would be it could be a major financial hit to the state.
it would be some hit,
Yeah.
and then I would defer to Pat
Yeah,
about
we don't have a
the
lot
exact hit.
of wiggle room right here.
So that's the way that they sorted it out. So it's a partial
Okay.
decoupling that applies to those larger businesses, but because of all of the options and the going back and forth with the amortizing stuff, it's just had a lot of law, a lot of drafting to have to deal with.
It's tax law.
Yeah.
Okay. All right. So it's larger businesses that this bill increases. It went. The percentage you could deduct.
The what can be deducted hasn't changed.
So what?
The amount of money altogether from
20% up
Vermont
to
really is.
50%.
What's that?
There was a major, I think Senator Chittenden asked, there was a major percentage change. I thought it was in,
Yes, you're thinking of the change in here for the Vermont R&D credit.
yes, that's what I'm
And
thinking.
it was increased significantly. It was increased significantly as far as the percentage of credit allowed, as far as the actual revenue impact. I don't know if you can call that significant, but yes, there's that change. And I don't have anything in your amendment related to that.
No, I just was wondering, refresh our memories, why they did that.
Part of it was with some of the corporate decoupling, it was quote unquote revenue generating. I don't know if that's the best way to put it, but I think you know what I mean. And so to put some tax benefit back into the income tax, that was an area they decided to target to be more generous with that credit, which would cost revenue.
Okay. And actually, and because that's R&D that's done in Vermont, so we encourage
That credit is
research and
specific to Vermont.
experiment to be done in Vermont. All right. Okay.
Okay, there's more. There's 3 places where, for clarity, I've put the word in taxable years.
Okay,
Without that, there could be some confusion about what the January 1, 2025 date means.
okay.
I may have passed it already, but there was one of the subdivision references, which was off by one. And so there's a correction for that in here.
Scrivener.
Hmm?
It's a Scrivener,
Scrivener. Sure.
but that Scrivener caused trouble.
And then we have one more that's a bit of this one. The first one is here. This is a correction. This is the correction I was talking about related to on the House floor. There was language that expressly did not allow Vermont's current 40% capital gains exclusion to be applied to the gains from qualified small business stock. And that was partially drafting related in the first place because Vermont under this language is decoupling from allowing the federal exclusion of qualified small business stock gains from being taxed at all. Federally, we've gone over it, but often those gains are not taxed at all federally. And so Vermont is decoupled from that treatment. But so at the same time, there was some clarifying language that you couldn't use the capital gain exclusion for those gains either because Vermont was making the decision not to allow the federal exclusion for that. But on the House floor, Reps Kimball and Kornheiser had realized that, we're not sure we want that treatment, so they would want to correct that in the floor amendment. And so I took out that express language, that wouldn't allow it. I should have looked at it more closely because for the 40% exclusion cannot be used for, I'll show you the language. It cannot be used for stocks or bonds publicly traded or traded on exchange or any other financial instruments. And this QSBS stuff is so complicated that at this point, the department and we can't quite figure out if it's stocks, bonds, other financial instruments, or all of the above. But what is clear is that you can't use the 40% exclusion under current law for this.
Okay,
And it's not relevant under current law because that federal exclusion of this gains doesn't flow through to Vermont. So currently Vermont's not taxing it all anyway. But under the decoupling change, we would be taxing it, but the intent for the House after that, based on that floor amendment, was to allow this 40% exclusion. So
okay, so we're taxing it, but it would have the 40%.
you could use and that's capped at 350,000 though.
Okay,
So here is and I was still working on this a few minutes before I came up here to sit down.
okay,
Is some language stating that basically that for the purposes of the 40% exclusion, will allow this for qualified small business opt-ins. Will allow that exclusion to be used. There's a plain language part at the beginning, and then there's also for the accountants basically some info getting
okay.
into the technical.
So this is the section where we are saying we're taxing them. We're not passing through that federal, you're not taxing them. But we are going to allow them to be covered under our capital gains exclusion. Is that what this paragraph is doing?
Capital gains exclusion could be used for those gains. Yes, that's what it's doing. And just so you're aware from policy sense, this would be the only type of financial instrument or stock that our 40% exclusion could be used for.
Right.
Because current law is that gains from stocks that are not something that you can use that 40% exclusion for.
Okay, so what just begs the question, why did the House
decide.
That's why I'm owning up to it, because it's like, I told them the 40% exclusion would be allowed. And I didn't dive into this part about the stocks and bonds are actually something you can use it for. But I did let Representatives Campbell and Cornezzer know about it, and I let them know that this is what I would be saying to you, was because they believe they were gonna allow this partial exclusion for qualified small business stock. So that's what this language for your amendment is doing. This is the floor amendment situation. This was a quick turnaround.
The
it's not a
40%
committee that-
is excluded.
Hmm.
But is it 40% is?
They believe the policy outcome is gonna be what these words are here.
Okay,
And so that's what I have for you.
all right.
They believe that the policy outcome is these words here.
Yes. Whether knowing that under current law it wouldn't be allowable, whether that bit of information would have changed the policy outcome they wanted, I don't know.
This clears it up.
Okay.
Right.
Hmm?
Clears it up.
It clears up the tax treatment, and the department will be able to do what it needs to do with this.
First.
Okay. Let's see what the fiscal note says. All right.
A lot of things, I mean, I'll give you a heads up. A lot of these, there's so few taxpayers. It's niche situations.
Yeah.
So just say about that. And then we have some things in the effective dates. We've already talked about pushing back communications property change. I have a note to also add the clarifying language from Maria. And then we also have here the effective dates, the pushing back for the grand list, partial change or mapping. And that's all. Those are the things I have so far for you. No tip stuff in here at the moment.
Okay.
No fish and wildlife fee stuff in here at the moment. Still the House version.
Good with that. Chris, Patrick, do one of you have a fiscal note? I've got you all on the agenda. Either one of you have something that might enlighten us?
So Patrick Jerton, Joint Fiscal Office, the fiscal note, which you saw when we first walked through all this clarifying language does not actually affect any of the estimates that are contained within it. So it's still what you saw previously.
Okay. On the border. Okay. Committee. Senator Harding.
I'm assuming your intention is that we vote this out tomorrow. We're waiting on more.
If I could vote it out today, it would make me very happy.
No, are we waiting for John to have to draft something on the TIF?
Yeah, we need to have that, so it won't be until tomorrow.
Unless we do it do the TIF part as a floor amendment, because I'm sure that Senator Hewlett and Senator Shannon would love to do that, but,
Afraid it's gonna be. Okay,
well, can I just ask, so if we're voting this out so quickly, and usually we have more time with the miscellaneous tax bill to decorate the tree or put more candles on the menorah, whichever. But, there was
rewriting the tax code, but
or rewrite the tax code, whatever you want to do, but there was a bill that I introduced earlier this year that was a rewrite of a bill that I introduced last year that I was hoping we were going to have a chance to take testimony on in the context of the miscellaneous tax bill, which is the tax credit for unpaid caregivers. And there was just a report that came out. I'm not suggesting you try to put it on this bill, believe me, I'm not. But I was hoping that we could at least take some testimony on it so we could get some feedback from the department, because it's different than it was last year, and it would be helpful to hear from them on it.
Okay.
Especially since there was just an AARP report that came out that underscores the data and provides more data and might be more helpful to
So we
have
could
when he's.
do that. I don't know that we can set it up.
I understand that we don't have time with with this bill. Unfortunately, I was hoping we might, but I understand
Well,
we
they
don't.
might send us a tax bill.
But exactly, so if we have some time next week for some testimony on that, I would appreciate it.
Yep.
I think it might be nice
You
for.
can just let Charlotte know who you need.
Okay, thank you.
Okay, I'd like to go through this section by section just to see where we are. Do you have some?
I was just gonna mention section 18 and 19 that you opened up. It's the other area that we get to committee. We probably want to give Village Council some direction on before we vote to say how's going to use the SGO.
Oh, yeah, yes, that is, I have two red flags. One is section 6. I think we've got some clarifying language and we'll modify it and hope that that gets to be a little more copacetic. The other one was 18 and 19. And I don't. That's all. We've got things to research and development tax credits. The downtown and village center tax credit, we want to fight that battle again. It takes it up to 4 million, and it came over to us in 4 million in a Senate bill. We took it 3.5. It increases it by 1 million. It's hanging on the wall across the hall.
Across the hall, it's 3.5, and that's what we just.
We said,
Where's the end today though? So
They stripped it, yeah, but
yeah, it's all like, I was told,
that's on their wall.
money chairs that they added up all the requests on the wall. And that they are at $10 million more requests than the House budget. So. They're having less fun than we are over there making those decisions.
Well, I think.
I-
Go ahead.
No, sorry, I didn't mean to jump in there.
Out of respect for our colleagues across the hall, keeps it 3.5.
Yeah, we already had voted that, but then that would be another
We're gonna
change.
just,
They go
we'll get
$500
it.
million
All
per person.
right. So we're gonna go with 3.5 in the tax credit on
Page 53.
50, is it section 53?
It's section 59.
59, that's right, though. Yeah, all right, so 59. Income tax code to the federal,
Okay, so I recorded that as something you want changed. Second change.
yes.
Okay.
Yeah, don't increase it by 500,000. Did the RP.
I just figured 500,000.
Effective dates.
Oh, we can figure out what.
Okay, the other one we need to talk about. This is the statutory distribution of meals, rooms, purchase and use. This is in this bill, not in the yield. This is the section. The issue is that the Transportation Committee needs money. The governor has proposed transferring $10 million in general fund this year. But from now on, and next year, as I understand it, the ed fund, purchase and use tax, will transfer 20 million, the next year 30 million, up to $50 million out of the ed fund over 5 years to transportation fund at 12 million plus or minus dollars a penny. That comes to 4 to 5 cents on its own. I'm not sure what transportation is doing at the moment. I know they're doing that.
Well, I can tell you that. I'm sure
Oh,
if you
okay.
want. If Christopher Fiscal, if you want, I can put a few slides up that shows you what the Transportation Committee voted out this morning along
Well,
with.
they have voted.
They voted
Okay.
it this morning.
No,
That
we
bill's
have a
coming your
bill.
way.
All right, I'm getting things on the mileage for electric vehicles, the mileage fee.
I just sent my very short slide deck to Charlotte to Chris. And I can walk you through it very quickly if you want.
Okay,
They're contemplating expanding the mileage-based usage fee for everybody. 4 or 5 years out, eventually. yeah.
okay.
So not the fee.
Anyway, what the bill before us does is it decreases the purchase and use tax by 10 million. It increases the rooms and meals percentage, so the ed fund gets 10 million and is whole. By taking money from the rooms and meals tax, we put a $10 million hole in the general fund. But if we pass this federal coupling, decoupling sections of this bill, we end up raising $10 million. So it holds the general fund harmless. It gives transportation a guaranteed 10 million going forward, where who knows what future legislators might do. This wouldn't preclude future legislators from doing anything, but it would give them some surety going forward and does not leave us with a $10 million hole this year or up to 50 million this year, but this year, in future years as well, in future years as well.
So Madam Chair, to your point, I have 3 slides that I can go through that compare the GovRec, what is in miscellaneous tax, and then what is in the Senate's T-bill. And you all will be there tomorrow. The first one, you just we went over this a few days ago, that the GovRec, $10 million, just remember the number 10 million. 10 million is the amount that needs to go into the T fund in FY27.
This year.
Correct. So, the governor had proposed a transfer of $10 million from the general fund into the ed fund to offset the impact to the ed fund of shifting $10 million of purchase and use out of the ed fund into the T fund. And then moving forward, he had proposed an additional ramp down by 10 million a year of purchase and use tax over a 5-year period. So, by the end of by FY31, all of the purchase and use tax would be going to the T fund. So that opens up a hole in the ed fund beginning in FY28 that grows over time, that all else being equal would be filled by property taxes. And my colleague Julia has told me that a penny, with lots of her caveats, a penny translates to about 14 million. So that's the GovRec proposal. The alternative scenario that was in the miscellaneous tax bill gets you to that $10 million number by shifting the meals and rooms allocation to go up to 83% into the T fund, and instead of the current 2/3 split, and ramps down the share that goes to the ed fund from 1/3 down to 27%. That shakes out to be roughly $10 million. That would be a shift that would recur in future years. That'd be a change in revenue policy until the legislature decides to make another change. To avoid creating a hole in the ed fund, 4% of meals and rooms revenue would shift from the general fund into the ed fund. So when you see how all of that sugars off, the T fund would keep roughly $10 million a year of additional revenue sort of on a basis until you all make a further decision. But the ed fund is essentially held harmless by shifting that around, so that there's not an impact to property taxpayers. The Senate Transportation Committee, H944, you're going to get this bill for several reasons, but one of those reasons, they voted out an approach that is a little more like the governor's approach, where in FY27, there would be a transfer of $10 million from the general fund to the T fund and leave purchase and use in the ed fund out of it for FY27. But then the phase down in purchase and use tax would begin in FY28. So that phase down actually goes through FY32, where the full phase out would occur, and the T fund would get all of the purchase and use in FY32. Why that's not on here is because the revenue forecast that we're working with doesn't go that far out yet. But you'll see that this has a similar impact of, there'd be no impact on the ed fund in 27 since it's sort of cut out of the process and the money would go straight to the T fund from the general fund. But moving forward in future years, as that purchase and use gets phased out, you start creating, for lack of a better word, a hole in the ed fund that is filled with property taxes by default when all else is equal. So those are the three different options you all are going to be looking at. When you get the T fund, there's obviously a conflict, or the T bill, there's obviously a conflict between that and what's in miscellaneous tax. So this committee is going to have to decide what to do to harmonize all of that. It would probably make sense to have the tax policy ride in the miscellaneous tax bill since it impacts all the major funds rather than continue to ride in the T bill once it comes over here. But you all are going to need to reconcile this, and that's also going to be needed to add clarity to your colleagues across the hall as they're trying to close the budget out.
And that's the proposal.
That's their proposal.
Yes, next year we will have a new legislator. Maybe we'll have a new governor.
You're running?
I don't know. I got enough trouble. So there is no guarantee in the House proposal that money will be ongoing and it won't be, you won't be losing, they won't get as much, but you won't be getting it by losing it in the ed fund. And I think we know how that's.
And it's not a 1 year transfer.
Right, it's a perpetual transfer barring. And as long as the tax gets paid, the tax should go up with inflation. But if the economy crashes, then all that's over.
Thank you, Madam Chair. Chris, I know you're not partisan. I don't want to ask you to do something you're not comfortable with, but can you summarize what the Transportation Committee, why they chose to do a different approach than the House, other than just keeping the general fund as whole as possible?
I think some of the concerns, Monsignor Gabriel, I don't speak for any of the committees, but, I think concerns have been raised about wanting to have a multi-year plan in place. There's not a lot of easy options to find the revenue. And I think that was the overriding concern was trying to think through what things look like beyond just 1 year. And there's also obviously the concern that many people on the appropriations committees always have about giving up general fund revenue on an ongoing basis. It's difficult to raise revenue for the general fund.
But didn't the House proposal have money going into the T fund?
Yeah, but it gave up revenue from the general fund.
Right.
So it was, perpetually giving up roughly $10 million. I think what the transportation committees tried to juggle a concern of giving up general fund revenue on an ongoing basis with their desire to see a longer range plan for transportation.
But now the money will be coming out of the ed fund.
Yes.
So that's.
And not 2 million, it will be between 50 and 60 million in 5 years.
The miscellaneous tax proposal is just a 1 year fix.
Yeah, I wouldn't say it's a 1 year fix. It is step one of the transition. It is not, and I'm really glad you asked that because it gives me another chance to opine, clarify this because I've heard it described inaccurately elsewhere in the building. And it's not like just transferring $10 million in FY 27 and then like, what do you do in FY 28? It is until they change or until you all change revenue policy, that shift of purchase and use and meals and rooms would be perpetual in future years. So it's sort of like taking step one of the 5 steps and hanging out on step one until you all make a decision to go to step 2.
They will get 10 million tax revenues holding.
Mm-hmm.
In perpetuity until we change it. They will get that percentage. If we pass the miscellaneous tax as they did, there will be $10 million to replace that in additional revenue put in along with covering the 25 so we don't lose 25 million. They're raising 10 so that the general fund is held harmless. It does, I know the chair, because he's talked to me on more than one occasion, wants an ongoing source of revenue for the transportation fund. It has traditionally been the gas tax. The governor's been very clear, he's not raising the gas tax, and I doubt, given the price of gas, any of us would like to do that this year. They are looking at a mileage, I don't know, but the whole nature of transportation is changing. Purchase and use is targeted because the biggest source of personal use taxes are you go to New Hampshire and you buy a car and you don't pay a sales tax, which is purchase and use in New Hampshire. When you register the car in Vermont, you have to pay purchase and use. It's a big item. It's a big amount of tax, and this was originally, there was an increase to the gas tax and an increase to purchase. And when we took purchase and use, we didn't touch purchase and use. When we did Act 60, we raised the gas tax as part of the entire financing plan for Act 60. At some point, somebody came to us and said, you know, this is just difficult to administer, and the transportation fund is getting all the rest of the gas tax, and the amount of the gas tax and the purchase and use are about the same. So they got the additional gas tax, and Ed's got purchase and use. Now they would like purchase and use back, which, since we haven't changed the funding since Act 60, puts that additional cost of education back on to the education fund. And if we can't find another $50 million worth of revenue, that over a 5-year period will let us pave a whole lot more roads, but it's going to leave us with a really big hole in that fund, in the ed fund. So
There's always the VIP tax.
there it is.
It's about the amount 50 million.
What's the ending?
So I have a question and then a statement, if I may, just to clarify, the vote was 5-0 out of Senate
That's
Transportation.
my understanding. I wasn't there for the vote, but that's what I saw on the committee report.
What was the question?
The vote out of Senate Transportation was 5-0. So I just wanted to overlay that with, I would interpret what you just presented that we're going to get from Senate Transportation as more likely the Senate position on this funding formula. And what we're seeing in H 933 is what came over from the House. And so with that, I think I also heard you say is it would be nice if we reconcile needs and almost pulled that position, that revenue stream into this miscellaneous tax to keep this thing flowing in the right direction.
I think I said you have to reconcile it. It would be ideal to do it in the miscellaneous tax bill, and I'm trying to respect committee jurisdictions when I say that.
So
The Senate Finance Committee has jurisdiction over revenues of the state, particularly if you're dealing with all three major funds.
So that was the question. And now the statement I'm going to make, and I'm very transportation biased just because I served on there. And I also just want to remind us, I hear other states have one fund. We have three, the general fund, the ed fund, and the transportation fund. And my understanding of why we have a separate transportation fund is the benefits principle of taxation, where you draw revenues from activities and those revenues are meant to support that activity. Purchase and use, I'm under the impression, I'm going to look is exclusively from the purchase of vehicles that use our roadways.
Yeah.
So it has been years past when we were taking in more money and there was rationale for it to segregate or send some of those purchase and use transportation dollars to education. We're no longer in that because we have more efficient vehicles. We've got declining gas tax, we've got EVs, all good things when you're looking at climate emissions. So I do support making whole the transportation fund gradually over time as contemplated in the transportation bill. I know that creates a hole in the education fund. What I would expect this and future legislators to continue to do is to use general fund dollars and additional tweaks in order to fill those holes. You can call it buy down wherever you want, but it's really just figuring out the right amount of allocation policies. But I see the ed fund, general fund dollars as a lot more fungible. And so I think what the Senate Transportation, which if it was a unanimous vote, the appropriations chair is on there, is a rational.
Very clear that he might not vote the same way as a member of appropriations. He was kind of put on the rack on the money chairs committee.
All that being said, I still also do support a gradual, and it's going to be revisited next year. We can't bind the hand of next year's legislature, but setting on a trajectory to bring purchase and use dollars back into the transportation fund, looking at the 5 and 10 year outlook. So I support just putting it on the table, taking the Senate transportation framework into this not miscellaneous bill so as to move these bills forward in a way that.
So you're supporting in order to make transportation whole, you will raise property taxes by at least 5 cents.
Setting that on the trajectory for years out for people to evaluate it later on.
Well, that's what you're setting up. You're setting up.
You're setting up.
Increased property taxes. That's.
Not this year. It would be next year, absent additional revenue funds from.
So why don't we
Raise
then
the funds now.
we raise the funds now, so we're not raising property taxes next year? We have a proposal that we've looked at in this committee and we priced out, we have analysis and language for. I don't want to put the T fund in a bad position. I want to make sure that we can fund our roads, but I also don't want to raise property taxes and put our schools in a bad position because we're taking away a revenue source from that fund. And as the chair explained, the history of it was swapping the gas tax for purchase and use. It wasn't like there was this funding source.
Gas tax for.
Exactly. We raised the gas tax, or our predecessors 2 decades ago, 3 decades ago.
Wasn't on.
Did it then. So it was a swap of funds then. It was not education stealing it from transportation. And so if transportation is going to take that revenue back, and I understand the nexus and I understand the problem, we can't leave the education fund in a hole. We have to be responsible and fix the hole.
This committee has a fiduciary responsibility.
Yes.
In keeping the fund, that fund whole.
So,
Scott.
so the kind of way I understand this is we're setting up for a return of the general fund transfer.
From
Build that.
No.
Well, then how are we gonna fill the hole?
This year, well, if we do this, if we do the decoupling thing.
Yeah.
We're raising $10 million, which now would fill the hole in the general fund if you do the house transfer. If you don't, the $10 million will come to Ed. You won't have a hole this year.
This year.
This year. Next year, you will have a $20 million hole because the 10 from this year will be in transportation plus another 10, and it will go up by $10 million increments until all 50 to $60 million.
I'm looking at that schedule here on Chris's number 5. It's 10 million in 28, 21.7 and 29. Am I looking at the right?
You are, and it's just, I don't have 32 on the chart because we don't have.
Okay,
for that.
yeah, right. And so what I'm looking at that is that effectively, in order to make the education fund whole in those years, there's going to have to be a transfer from the general fund.
That is not in any of the bills nor.
No, I know,
Yeah.
I know it's not, but it seems like that's kind of where we're setting our, that's the table that's being set.
The governor has not said that.
Oh,
The
no.
appropriations bill has not said that. We could also transfer 10 million additional dollars a year into transportation. Which is, right now, we are doing so much to education funding and asking, there's so much uncertainty and angst out there I can see the headlines of the St. Albans and the Times Argus and Burlington Free Press of the Caledonia, Senate votes to put $50 million hole in the ed fund. I just don't think any of us want to
Right.
go home to that.
But the only, I guess, and the point I'm trying to make, I think I'm doing a very good job, is that if we don't do anything,
How long is she?
the ed fund is short. Okay, which means that the only way for the ed fund to be whole and not have it just go to property tax is to transfer money from somewhere into the education fund. So I think, and I'm not saying this is what we wanted to do, but it would seem, I mean, the old days of we fought over the general fund transfer every year were miserable, to say the least. So we got rid of it in 2018. Okay,
Well, it was miserable in appropriations because
Yeah.
earlier in the century, they had to hatchet safety net programs
That's
to
right.
give an increase to the
That's right.
schools.
and we just fought over the general fund transfer for years. So, and I'm not saying this is what I'm supporting as a proposal or, but the only way to avoid that fight and to make sure the education fund is full is to change the distribution of the consumption taxes, not the purchase and use, because I think that's one of the, so we're talking about, and we've got 100% of the sales tax. So the only thing left is meals and rooms.
Let's create a whole ed fund.
No, I'm just saying to
Raise it?
fill a hole in the ed fund. If you're not gonna do a general fund transfer.
Right.
And you're not gonna put it on property taxes, the only thing left is to increase a consumption tax that's coming to the ed fund. Now, that creates a hole across the hall.
Right, so in order to not create holes in any of the
Yeah.
funds and to have a longer term fix, we have to raise revenues. And if we do nothing, the revenues we're raising is property taxes. Because that's,
If we do not,
if we do nothing, if we don't raise a revenue. So that's why I'm suggesting we look at how do we raise revenue in order to fill the hole in the
Right
in the
now, if
education
we
fund.
do nothing. The property tax is what it is. There's no hole. There's, the budget is whatever the budget is. And somebody is transferring $10 million in a one-time shot.
That's what this does, the
This,
House proposal.
the House proposal, no, the House proposal transfers a portion of the purchase and use, not all of it. $10 million worth of it. It doesn't raise, it raises the percentage of rooms and meals, not the tax that goes in to the ed fund by 10 million. So the transportation fund is up 10. They don't have a long-term plan.
Right,
But we don't have a long-term plan to replace a $50 million hole in 5 years in the ed fund. So it's trading the hole. This bill with the decoupling raises $10 million, which goes into the general fund.
Right.
Transportation's getting 10 million.
right.
Everybody else is
I
out.
understand
And
that.
that's
I'm just saying that we either do what's in H 933, which doesn't create any holes.
Right.
But it's only essentially part of what the T fund needs. My understanding,
Right.
Kristen, if I'm wrong,
But
that's
it's
not
not build it.
but it doesn't build up on the T fund. And what I'm hearing you say is that, and what the governor's proposal also did was build up revenue in the T fund by taking it from the ed fund. And if that is what you want to do, we need to fill the hole in the education fund. Otherwise, the default is that we're raising property taxes. And so we need a revenue source. And that's why I'm suggesting if we're gonna do something that create a hole in the ed fund, we need to fill that hole this year. That's the responsible thing to do. And we talked, and we have estimates on what was called the wealth proceeds tax, but it's a narrower, or the in Vermont investment proceeds tax, which is a narrower tax. And we have estimates that could fill almost, I think it's 50 million, and there's, we have a scenario that would give us 48.6 million, and the timing could work out to do so. Because there was that 1 year lag, remember, Madam Chair, it could start next year, but the 10
But
million.
that's also income tax.
Well, but it could be deposited
dedicated,
because it's a dedicated tax, it could be deposited into the
Would take that tax.
ed fund, so.
So if I may, what I think I heard Senator Beck say, and to your point, rather than create the hole in the ed fund, since I'm seeing us have a general fund transfer debate anyway with this buy down, what if we shifted the revenues from the general fund towards the ed fund, covering the 50 million, effectively creating a hole in the general fund, which has many other revenue streams, and just to, I mean, that's where the income tax is.
It's mostly income tax.
And that's what you're advocating for, those who go into the general fund. Do they not?
This is a zero sum game. Unless you raise new revenue,
Income tax currently.
So what do you think?
unless you raise new revenue, then if you're moving $50 million out of one fund and into another, somebody is going to have a $50 million hole. The ed fund is whole. There is an ongoing problem in the transportation fund. We can get them relief, and that's all they're going to get for 1 year if we do all the transfers. I don't think we have time right now to rewrite the entire ed fund, general fund, and transportation fund. I understand their need for a long-term plan. We are working on a long-term plan for education financing, trying to get the costs down. We have spent several very painful years moving in that direction. This would just throw a huge hole in the middle of all that planning. And
you're saying the transportation fund structure will create that hole. That's what you're.
if we take the money out of there, it will create that hole. And this will give transportation $10 million, all things being equal, going forward. If we're going to do why are we getting into a transfer from the general fund to the ed fund? If you want to do a transfer, the fund that's in trouble is the transportation fund. Do a transfer to the transportation fund and cut other state programs. But if you want to put more money in, you've got to raise more money because there is no extra money right now.
Yeah, I think it's simple. Either create a general fund transfer, which creates a hole in the general fund, or you calve off a consumption tax that's currently going to the general fund, and you direct it to the education fund. They both create the same hole in the general fund. Just
Well,
one
no,
of
but
them.
we are raising money in this miscellaneous.
No, I know. We are, but I'm saying if you do a general fund transfer, there's a hole over there. If you calve off a consumption tax, there's a hole over there. The difference is, if it's a general fund transfer, you're gonna fight over it every year.
Yes. Well, no, it was written every year that it will, and it will go up, I believe, by
Right, and then they fought over it.
what, yeah.
Yeah.
So we could do the S or H 933, which is a 1 year fix.
That's what's in this.
Yes, and it raises the $10 million and it does the swap that Chris can tell us about a million times more. And then we could do the permanent switch of purchase and use out of the ed fund over to the transportation fund. If you want the nexus, we're buying cars and so the revenue is gonna go to the T fund. And then, I don't know, I mean, that's one of the arguments, but, then we could do the S-282, Vermont investment proceeds tax.
And raise.
And raise the 48 million that is essentially the same as the purchase and use tax. And it needs a year to get it up and running, and then that can go into the ed fund and the purchase and use can go into the T fund, and it's a more permanent
If it
fix.
doesn't get vetoed.
If it doesn't get vetoed, all of that's the caveat on all of this, but I mean, it seems totally irresponsible to not have a long-term fix if we're gonna, and I don't wanna go back to fighting over the general fund transfer and figuring out what we're gonna cut from the general fund every year. That's not fair to all the programs that are from there. It's not fair to raise people's property taxes. And we need to fill the hole in the T fund, and especially because you don't want to leave federal funds on the table. And that's one of the things that happens when we don't fully fund the transportation fund.
The VIP tax could also go directly to the T fund and fill, and because that would make the T fund whole very much more quickly than the 5-year ramp up.
Yes, we could just do it directly if people don't care about the nexus thing of the buying cars go into the ed fund or the T fund.
Committee.
Let's talk about gas taxes. You guys want to raise the gas tax?
That's
Really not a good time for that.
I'm really not fond of tar and feathers. And that's 6 months ago, I would have talked to you. Cause I've been looking at the gas rates around New England. Right now, it'd be suicide.
So then what's going with the transportation bill, I'm sensing there's not going to be support for, but this 933 construct seems to generate new revenues with the realignment, the decoupling. So that fills in a way this hole for this year. It doesn't meet the transportation funds hole years out. That's a problem for next year's legislature, whoever's sitting around these tables.
That's what this is getting us.
33 now?
It's the 1 year. So
This
giving
solves this
10
year,
million more.
leads into next year's legislature.
That's the point. But you know, we all seem to spend all of our time talking about raising funds as opposed to stopping spending.
That's that committee.
And that may be their committee, but it's something that we all ought to be thinking about. Because we can't continue to do what we're doing indefinitely. And this 5-year plan seems just like that.
But in our defense, we're the tax committee, so.
I realize we're the tax committee, but we're also people who have constituents.
Right.
And there has to be a point in which we have to say, stop spending. That's what the private sector does consistently.
Except.
When you don't have enough money to do something, you stop doing some things.
Well, we
the
have
transportation
the roads in Montpelier
Yeah.
lately. I mean, the roads are not getting paid.
Well, again, it's a
Yeah.
question obviously of prioritizing what we do, which as a whole legislature, that's what we do.
Well, we are moving towards a foundation formula, which will reduce ed spending.
Well, the issue is we have to move a lot faster than we're moving. We're moving in a snail's pace.
Well, next week, the education bill and funding will be here.
It's-
And we're gonna
Maybe.
put our money where we is. I haven't seen any, I haven't.
Okay, what we
heard
have to
any-
sign in every committee room in this building that says stop spending.
But we are working on that. This is.
I do
level
think that, I mean,
funding.
to be fair, Senator, I mean, I hear you, but I do think they're saying that across the hall a lot. And I do think in all of our committees, when we're putting together our budget letters, they've been much, much more conservative, narrowed down, compared to just a few years ago.
Compared to a few years ago, but there again, the issue is compared to a few years ago isn't good enough for what we need today. We're at a crunch.
Okay, we are getting off topic. We are not spending in here. We are trying to hold everyone harmless. And we are actually putting some money into transportation. Jill Remick is available to talk to us until 4:45.
we're going to have to make a decision. I'm gonna give you a 10-minute break, and when we come back, we're gonna start doing some straw polls. Okay, and then on all of this, we're gonna have to bite the bullet between now. Or we can just let this bill die and nobody gets any money.
Can I ask a quick question?
I think we need to put on the bill.
So,
I can leave things on the
Senator
water.
Chitman,
Yeah, like,
what's the benefit of this doing a one-year fix other than expediency and simplicity at this point?
Seems politically feasible.
I mean, if I,
Just, you know, 33 solve it this year, doesn't solve it out here.
if I take Randy's comments, okay? And I say, you know what, we got a plan here to solve for 27, which we seem agreeable to, okay? And I say, you know what, 28 and beyond. If we're gonna do a whole in the general fund, then we're telling the administration, when you bring your budget next year, figure it out in your general fund budget.
That's what we're doing, is that every private corporation, that's what we'll have to do.
Yeah.
Is you have to figure out how you're going to deal with the revenues that you've got.
By doing 933,
No, but
No, by telling the, they saying, hey, we've constructed this, if we continue to do this purchase and use order schedule.
oh, so that is what's in 933.
Yeah.
Okay,
They've got to fill the hole.
no, what
Nine
what you're,
thirty-three is.
you're making the argument for what the transportation committee
Yeah.
has passed out, yeah, so he's making the argument to create a hole and raise property taxes.
No,
There
they're
is
saying create a hole and have it addressed through budget next year.
There's a T fund hole that we're just trying to fill, but by doing so, we're.
Yeah.
Creating, yeah, and that
There is a-
goal is, they want $60 million, and that is coming out of the education fund, which is somewhere around 5 cents plus or minus, plus all the incremental costs, because their fuel oil is gonna go up this year. So you're probably, you're looking at this year's increase just by taking that money out. And the education fund is our responsibility. To me, that is a violation of our fiduciary responsibility to start putting a hole in there and saying, let the governor fix it next year. Because what if the governor doesn't fix it next year?
Will be in the general fund, is what Scott said.
It'll be on the general fund.
How would it be in the general
What's he
fund?
saying?
All I'm saying is, if you set up a construct where, and I don't know what, if you, whatever.
Say that whatever gets taken out of here in purchase and use, they have to give us.
In.
I'm trying to make an argument for doing more of going back to a general fund.
No,
grants.
no, I'm not. I'm saying if we're looking at a situation where there's gonna be a hole in the education fund.
Well, there isn't now unless we change something. We're going to create,
933 or the transportation fund.
The T
right
fund is
now,
created-
if we take,
Yes.
if we commit
T
to
bill.
taking purchase and use out of the education fund, we are creating a hole in education.
Right.
In order to fix a problem in transportation.
Yes.
That problem is not the problem of education. And so why are we and probably the most painful tax for people to pay is the property tax. So why are we putting the burden on the property tax
Well, I don't.
and taking it off?
I mean, I'm looking, if I'm not a supporter of making the education fund short because I don't want to put it on property taxpayers. But I'm looking at here, there's $185 million of meals and rooms going
Where
to the
is
general fund. There's $249 million of corporate income tax going to the general fund.
Yeah.
If we simply calved off enough from those, one or both of those sources, I don't know, or we could take more meals and rooms. to fill the education fund, so it doesn't show up in property
Well,
taxes.
then give it to transportation.
Well, that's what you're effectively doing, is recycling, it's just creating a
Yeah.
hole in the general fund rather than
Yeah.
the.
So we are creating,
Which is where income tax-
we are creating a problem by doing that. You're creating a problem for the
We're
general fund.
switching yes, we're switching the problem.
Right, and then where does that hole get addressed? Well, I think number one is the governor addresses that in his budget.
Which could be including.
So
Governor
just,
Cummings,
right,
Could be an income.
that the general fund shall transfer $10 million a year into the transportation fund. Why are we getting the education fund involved?
No, I think what you're trying to say is we're gonna ramp down the purchase and use
And the
tax
purchase.
in the ed fund.
Yep.
Goes to the T fund. And to fill that hole in the ed fund, you're gonna ramp up rooms and meals tax, which would fill the ed fund back up
From the general.
from the general fund. General fund will come down. And then there'll be a hole there signaling to the governor, who's ever there,
That he will
you
cut
have
other
$10 million
programs.
less. Figure that out in your budget.
It's not, we're raising 10 million. We're not talking 10 million. We're talking 60 million.
Over the course of 5 years. Yes.
Well, eventually.
Still $60 million dollars.
Yeah.
And so I am not, I will put this bill on the wall and not take it up if we're going to put a hole in the education fund at a time when property
That
taxpayers.
would not.
They're,
No, that's not
they're
what-
suggesting
You
is
wanna
putting a
do
hole
it-
in the
You
general.
want to do something, we will write that there will be an incremental $10 million a year transferred from the general fund to the transportation fund. That's clean.
And leave the ed fund out of it.
And leave the ed fund out of it. Why are we getting the ed fund in it?
Well, I think we're trying to take purchase and use and move it back to the ed fund.
Why?
Because it's purchase and use and drawn.
Yeah.
Participation funds benefit.
And they could probably also try to
It
send the
was set
signal
up
to
at the
those who fund the
request.
education fund, that is what is the one that has been foundering for so many years. And there's been just nothing but talk rather than action in terms of
Well,
addressing
the
it.
governor
That is
hasn't
absolutely
taken
not
any
true.
action
Not
in his
fair.
budget
We
either.
had a lot of great talk.
I mean, if
but I don't see a lot of
transportation
results.
doesn't want the purchase and use tax, then we're out of it. But they want the purchase and use tax.
So doesn't the education fund.
I know, and that's why
So
we're,
find
that's why
me,
we're.
so find me $60 million.
Well, I'm fine with H 933,
You-
solving it this year, solving just H 933 from the House, solving just this year's problem, not doing any of this other stuff. I'm fine with moving that forward. But to the point that I think Senator Mathis just very clearly articulated, I'm not advocating for it, but I would support that only because the general fund is primarily sourced with income taxes as well as others. So a VIP tax would then go into the general fund, and maybe next year's governor, Governor Cummings, Governor Richards, Governor Scott would maybe propose one of those taxes to fill the general fund hole, keeping the transportation fund benefits principal, drawing transportation dollars in the end. But I'm fine with H 933 as is. We gotta move it along. All I'm saying is I see merit in how they just articulated that readjustment in the
I
line.
think we are getting them 10 million. We are arguably kicking the can down the road till next year.
We do that well.
But I don't want to go home and tell my constituents that,
I don't want to leave a hole in the ed fund.
no, I don't either.
And whatever we do, and it may not be the we in this room, but whatever state government does, whether the legislature does before going home, is come up with a plan of how we're going to reduce spending as well as raise revenue, but reduce spending.
They can both be done. It's not an either.
They both have to be done, not one. We always talk
Well-
about how we have to get more money in. What we have to do is know how to get better results from the money that we got.
Well,
And we
we
can
are-
do a tax on passive income on the wealth.
We are moving
Look it up.
forward with the governor's plan for education, which is supposed to do exactly that. That's why this is the worst possible time to be supporting a plan that envisions removing millions of dollars from the education fund before we get there. Because remember, we know we've got high spending towns, we've got to ramp down. We've got low spending towns, we've got to ramp. I'm going to give us a 10-minute break. Then we're going to come home
And we're gonna hear from Jill Remick on, what were we hearing from Jill?
Broadcasters.